Okay, ex-traders, this is a trial run for the trade strategy presentation. This is the trade strategy video, and I'm going to try to cover the following topics as briefly as possible. The first topic is basically talks about the three realms in which we have to be fluent: technical analysis, fundamental analysis, and rules. And then once we have that down, we can talk about which learning path is better suited for our needs and characteristics. And then finally, define success and begin trading. So let's jump straight into the three realms and start out with technicals. Technicals is like taking an x-ray of your ticker. Okay, so you are going to be looking through a lot of different charts and images to try to figure out basically, where this thing is and where it's headed. Technically, we cover four main areas: the overall trend, which is probably the easiest one; support and resistance levels that are defined within that trend; patterns that form and what indicators are telling us; and finally, we take a small glimpse at the Greeks if we have the right tools and platforms. All right, so let's jump right in. A trend is, like I said, the easiest one. It's the easiest one to spot, and it's indisputable. Basically, nobody, I don't think, would disagree with the fact that this is a general uptrend. This is SPY, I believe. Sorry, this is Dow Jones. This is a general uptrend. If you look at it in the past, this is probably 5 years. Okay, nobody would dispute that this is an uptrend. But there are trends within trends, and if you look at a smaller window, like 1 year, which is probably 2022, you will see a definite downtrend forming. Okay. However, within that downtrend, you can spot some uptrends here, another downtrend, an uptrend here, another downtrend, and an uptrend again here. All right. And there's also, besides uptrend and downtrend, there are general areas of chop. This is a big area of chop right here, where price action didn't do much, didn't change much. You can spot smaller ones like this little rectangle right here, this long rectangle right there, another little rectangle right there. Okay, so trend is pretty easy. You need to be able to at least define the trend, because the overall trend, like they say, is your friend, and you don't want to trade against the trend. Okay, if you're going to take a long-term position on whatever this ticker is, then you better know that there's a long trend forming down, and you probably aren't going to want to go for trades that are too bullish, at least not while this downtrend is in play. Same thing here. This is up. You don't want to go against the trend and take a bearish trade, at least not in that time frame. Okay, so then moving on to support and resistance. We defined three ways of identifying support and resistance level. The first was swings, which is technically defined as the lowest or highest, and then the two preceding candles and the next two candles after that are lower than the lowest, or higher, or also lower than the highest in this case. That is how you define a swing point. And then there are, and you can see these swing points here marked in yellow. Sorry, there's one right there, one right there. Okay, they stem off of this. This is the lowest low, a lower low. This is a lower low. This is a higher high. All right, and then there are levels that are defined by multiple touches, such as this one. This is, it might be a swing point at some point in time, as it is here and as it is here, but it also has a lot of touches. You can see how it served as support quite a few times here and then broke through. And then here it served as support again. Support, support, support broke through a little bit. Support broke through quite a bit. And then it quickly climbed over it, and then it broke down, and then resistance on its way up. It tried to go across that support, that resistance, but did not make it through. Then when it came back up here, it touched that line again, and then it bounced back down. It didn't go through. And here, it bounced against that until it finally broke over. All right, so this is the multiple touches way to find support and resistance levels. And then there's the fibs, probably the easiest of all of them. I usually take the highest high and draw down to the lowest low. So basically a 52-week high down to the 52-week low, or vice versa. And then some of them, as you see, line up quite nicely with swing points with multiple touches, and some of them don't line up quite so well. So if they don't, then you don't have to mark them. Obviously, the fib indicator or the fib tool will mark them for you. And moving on to trade plans. Once you have identified those support and resistance levels, and once you have confirmed the trend, as in this case it is an uptrend on a much smaller time window or time frame, but it is an uptrend, then you lay down your trade plans using the trade tool if you're using TradingView, which in this case is represented by these red-green boxes or rectangles here. The entry level is the line between the green and the red. The stop loss is the bottom, and the absolute highest target is, or price target, is the end of the green rectangle, and the opposite is true for the short play. So you want to use both the long and the short play in case your ticker either goes up or down, even though you are bullish. If this thing is headed up and you only set up the bullish tool and something happens and it goes down, then you're going to miss out on a possible play on a bearish momentum. So what you do is you look at the price level that you are at, and you look up at the nearest resistance. If broken, then you have the entry level to the first price target, second price target, and whatever's up above. Or from the current price level down to the nearest support, if it breaks, that's the entry level to the first target, the second target, the third target, and so on and so forth. And that is basically what you do once you've identified trend, both on the larger and the smaller time frames, and once you have identified your support and resistance levels. Now you move on to the price chart in a way to try to find price patterns. Price patterns can be as sophisticated as a head and shoulders, for example, as you can see here, which ended up heading a little bit lower, or as simple as price gaps, which are also important. So also don't try to force these price patterns as this one clearly is. If it's not there, it's not there. Don't try to mark one where there isn't one. And then there's easier patterns such as double tops, all right, which could also signal downside in that case, and then the typical bull flag, which is one of the more common ones. All right, so those are price patterns, and only once you have trend, support levels, and price patterns do you go ahead and look or turn on your indicators to confirm what it is that you saw in your previous analysis. Now this is an example of the Neptune trading system, which is NTS. This is designed by the JTW analyst here at Xtrades, and you can get that for TradingView here in our Xtrades app in the X Hub. And basically it gives you some moving averages, it gives you some long signals, some short signals, it gives you some bull and bear flags on different time frames as well, depending on what you're looking at. And you can bind that with other indicators such as the MACD in this case, or the RSI and volume profile, for example. Okay, so that is basically the technicals. And just to review, you look at the overall trend on all relevant time frames. You draw support and resistance starting from the largest time frame down to the smaller time frame. You've identified chart patterns, and then you turn on indicators. Okay, and then we will leave the Greeks and the probability technicals for a standalone video because they are enough material to cover just in that in those two concepts of Greeks and probability to make their own video. Okay, so let's jump into fundamentals. Here, there are different fundamentals such as the general market sentiment. You have to be aware of what the general market is feeling. There are some gauges such as the fear and greed gauge, which is available on a lot of different websites, and that basically tells you how much fear and greed is in the market. There are reports on general trader sentiment. There are even social media gauges nowadays, which wasn't a thing before the 2010s probably. And again, the trend of specific ETFs or other market tickers such as SPY and the Dow Jones and the NASDAQ, etc. Those can also give you an idea of what the general market sentiment is. Economic data you need to be aware of. There are economic calendars for the release of different and quite a few data points ranging from GDP, which has to do with productivity, or production, sorry, CPI and PCE, which are measures of inflation, jobless reports, which measure the health of the labor market, the PMI, mortgage apps, which talk about the market, the housing market. All these different indicators are released on a weekly basis, on a daily basis, and they have their own calendar. It is important that you know when these pieces of information are going to be released because they will affect the market as a whole as well as specific sectors. Then you need to obviously dive into a specific sector and know what is going on in the sector that you are trading the ticker. If you are trading a Boeing, then you have to be aware of the transportation as well as industrials or defense. If you are looking at Target, you have to be aware of what's going on in the consumer, both consumer staples and discretionary probably, as well as in retail sales, for example, and so on and so forth. Different sectors behave differently. The market doesn't move, as one cohesive block. There are different sectors, and sometimes they're up, sometimes they're down, depending on economic indicators and whatever's going on in the economy. And finally, there's rumors in politics. Of course, there are rumors of companies that are going to get bought out. There are rumors of companies that are going to go under or bankrupt. There are rumors about laws that are going to be passed, and then there are the actual bills and laws that are passed, and politics makes up a big part of hearsay and rumors, and TV news is important. Even though it might get classified eventually as misinformation, it is still market impacting. Okay, people will still react to a news bit, even though it might later on be classified as false or untrue. People will still react to it, and the market will react to it. And then finally, ticker specific, we have recommendations and upgrades. So we have companies and analysts all over the country and the globe for different investment banks, basically looking into company financials and what those companies are doing, and they come up with their own decision on what they think that particular ticker is going to do usually over the next 12 months. Is it a buy? Is it a sell? And they will upgrade or downgrade different tickers depending on what their analysis tells them. And then there's also the beginning coverage, which means when a company is possibly not that big, and eventually they start making waves in their market, then these investment bank and analyst firms will all of a sudden take a look, and notice this company and then start coverage. So it's the first time that they're going to put out either a buy or a sell recommendation or rating on a particular company. It means that that company is obviously noteworthy and is probably good idea to follow it. Okay, and then we have the general rules. Okay, and we talk about risk management. We talk about different perspectives for looking at trades. We talk about different assets, strategies that you can take, as well as platforms and tools. And we have specific videos for these topics that you can find in our X-Trades channel on YouTube, and I will link to some of these that are already available here. But in risk management, we talk about how to properly size your trades, how many contracts to get, what size, and how to manage runners. We talk about perspectives. When you take on a trade, do you want to look at percent or absolute? Definitely want to look at percent return. And once your trade reaches a certain percent return, then you begin to scale out or exit the trade completely. You have to look at trades from different perspectives. There are day trades, and then there are swings, which are longer term trades. There's assets that differ depending or are more or less suitable depending on the type of investor that you are. And then there are strategies, which are actually option strategies, which basically give you alternatives to trading options. Some people are better at trading stocks because they are too jittery for options. Well, options have different types or flavors. You can have individual options, which are called naked or singles. Then there are spreads. Then there are strategies where you can wheel. And then there are dividend strategies. And then that's why you have to look at the Greeks if you're going to get into these, or even if you're just going to trade singles. So if options, you start having a run of bad luck with options and you think they might not be for you, you might want to look into strategies or go back to trading stocks. And tools. There's a whole bunch of different platforms. I have a video out on trading platforms, which I will link to here. I compare E-Trade and Thinkorswim, and I look a little bit at TradingView as well. There are a lot of different indicators that you can use. Some on TradingView which are community indicators, and some which are obviously privately sold. And I talk a little bit about how to calm your nerves if you're a jittery trader. And of course, having a drink, one drink, is a good way to do that. So some of you might find that to your advantage. All right, so then we jump into learning paths. So you know how to do technical, fundamental analysis. You know the general rules for trading. Now let's get started with your trading. In this, you have basically two main types of traders. You have your paper hands traders and your diamond hands traders. Paper hands traders are basically jittery traders. They are more conservative. They don't like risking a lot. They are therefore risk averse. Sometimes they mistakenly or erroneously take small single contracts, which is something I cover in risk management, which is a mistake, because just because a contract is cheaper then you jump into that trade thinking that you're going to go and make some money off of it, but maybe you should think of why that contract was so cheap. It was probably a lotto. It's probably very low probability of that thing going in the money, making you money. So maybe that's not, the best thing or the best way to choose your contracts. But basically, it happens when people are new to options trading and they don't have enough education in options and they don't have all the available strategies that they can use. Or it can happen because people are simply jittery and that is their nature, and that's fine. You just have to identify if you are paper or diamond hands. Pick one, be true to yourself, and there are different ways of trading for each one of these learning paths. The diamond hands trader is, the guy that you always see, who made 100, 200, 500% profit on a trade. It was usually a naked or a single call. He is more, or she is more, the gambler type. They are definitely risk on. They kind of go all in on certain things. They ride contracts to high percentages, like I said, maybe above 100 or 200%, just to give you an idea. I'm more on this side. I'm definitely more on this side. I'm way more conservative, and I usually ride contracts to 15 to begin with, 15%, and then maybe 30%, and maybe 50%. Every now and then I'll get 100%, but that is like possibly once a month. All right, so it's important that you recognize these sorts of things while you are trading. These are people that have a lot of confidence, and that's fine. They also can be the type of people who have a lot of education. When I say education, I don't mean general education. I'm talking specifically about options trading education. Very important distinction. And they are people that, because they have all this education, they have all this knowledge of options trading, then they know all about the different tools and the different strategies that you can use to be more confident and get the most out of your trades. And then finally, we need to define success. Okay, and I will give you a perfect example for this. To define success, you have to know thyself. This is also important when you're choosing your learning path. You have to identify whether you are a full or a part-time trader, because if you have a full-time job, which means that you are only a part-time trader, then you're not going to be able to be glued to the screen all the time. That means you're probably not going to take day trades or scalps or lottos. You are going to be able to take, you're probably going to have to take something like spreads or longer term swings. Obviously, that also matters if you are risk averse or risk on. The psychology of a trader is super important, and that is, again, what defines the learning path you should take. This is an operation for the long haul. Like any business, you have to be in it for the long haul. If you're actually going to make money, you're going to lose money. You're going to lose money on certain days. You're going to lose money on certain weeks. You're going to lose money on certain months. Okay, but over the long run, you need to be able to exercise proper risk management and sizing to be able to limit your losses so that you have fewer of those losses, and those losses are smaller in size, which means that the wins will eventually overpower the losses. And probably the best way to describe this is one of my favorite phrases. I believe it's on my Discord: slow and steady wins the race. Okay, so that is basically it. I just left one thing out: the definition of success example that I was going to tell you guys. When I started, I took out, if you're not an X-Trade member yet, I highly recommend it. When I started, I took out a monthly membership because I thought, okay, that's small enough. It was $48 that I can actually, I could probably make about $10 to $12 a week, and that means that I'll be able to pay off my X-Trades membership. And then after the first 1 or 2 months, I believe, I basically decided that it wasn't worth paying the monthly membership for a couple of reasons. Number one, I could make a lot more than $48 a month, even as a conservative paper hands trader that I was and still am. But also, I realized that it wasn't doing me any good because I was putting this extra pressure on myself to actually trade every month because I was paying for a monthly membership. And in my mind, paying the lifetime membership basically, freed me from having to take trades. And guess what? You should not take all the trades. If you learn technicals, if you learn fundamentals, and you garner enough knowledge that you can choose your learning path, to decide the type of trader that you are and which path you're going to take, you will reach a point where you realize that you don't have to take every single trade. And sometimes, some months, it's not a good idea to trade because the market is just not working for you. Okay, so if you remove that monthly pressure of having to pay for your membership with your gains, and you go and you pay for the lifetime membership, then that's a load off your back, and you can focus on maybe using those months or weeks or days where you don't feel like trading, or maybe you don't have the free time, the spare time to trade every single day or every single week. Then instead of pressuring yourself into taking a trade just so that you can try to make enough money to pay for the membership on a monthly basis, you can use that time to analyze, learn, and grow as a trader, interact with the community, pick up tips here and there, learn about different strategies, different tools. And that is when I basically decided that my definition of success was no longer $48 a month I wanted to make. And then obviously my definition of success now is a lot larger, and my education has been able to follow suit, and I'm quite happy with that. So I hope that with this quick presentation you have acquired the knowledge of what things you need to cover and master in order to become a successful trader yourself. All right, so I'll see you guys in the next one. Have a great one.